Kenyans can expect steady fuel supply for now, even as fighting in the Middle East raises concerns over global oil markets. This is according to the government of Kenya that says the country has enough petroleum stocks and planned imports to avoid immediate disruption. However, with oil prices already rising and shipping routes under threat, there are growing concerns about what this could mean for pump prices in the coming weeks. Jasmine Wamboi reports.
The Ministry of Energy has moved to calm fears of a possible fuel shortage. In a statement to newsrooms, Energy Cabinet Secretary Opiyo Wandayi says the country currently has sufficient stocks to meet local and regional demand. The statement reads in part, and I quote, "We have scheduled imports for delivery up to the end of April 2026, and therefore, as it stands, we are assured of security of supply." It continues to say that the government is closely monitoring the fluid situation as it evolves, while engaging with our G2G suppliers for contingency planning. The reassurance comes against a backdrop of escalating conflict in the Middle East, a region where Kenya sources most of its petroleum products. The widening war has disrupted movement of oil tankers through the Strait of Hormuz, a narrow but critical shipping route that carries more than a fifth of the world's oil. Some shipping companies have suspended transit, while insurers have sharply increased the cost of covering vessels moving through the Gulf. As a result, global oil prices have been affected. Brent crude, which is a benchmark used to price much of the world's oil, has jumped about 10% to around $80 per barrel, with analysts warning prices could climb higher if the conflict persists. The situation could also test Kenya's government-to-government fuel supply arrangement with three Gulf-based oil giants, that is Saudi Aramco, Emirates National Oil Company, and Abu Dhabi National Oil Company. This at a time when Saudi Aramco has been forced to shut down operations at one of its refineries after an alleged Iranian drone attack. The G2G agreement is aimed at easing pressure on the country's forex reserves and supporting the shilling. And while freight and premium costs were negotiated in advance, any sustained rise in international crude prices would eventually filter down to local pump prices, adding pressure to inflation and household budgets. Beyond fuel, the broader trade relationship is also at stake. Kenya's trade with the Middle East is valued at over 700 billion shillings every year. The region supplies fuel, fertilizer, machinery and electronics, while Kenya exports tea, coffee, meat, flowers and re-exported jet fuel. Jasmine Wamboi, Citizen.